Alibaba now says that its strategy has never been to compete with the likes of Amazon and eBay, and the focus has always been on the American business, not the American consumer.
Charlie Munger, the founder and CEO of Daily Journal Corporation, is one of America's most well-known value investors. A significant investor flight from growth equities to value plays has occurred as a result of rising inflation, volatility, and a massive drop in the values of growth equities. So today in this video, we'll discuss Charlie Munger's take on Alibaba stock and why Alibaba should focus on the USA. So make sure to stay tuned until the end to find out. Let's begin. Warren Buffett is well known for becoming greedy when others are afraid. Charlie Munger, his right-hand man, isn't averse to going against the grain. Munger is the chairman of Daily Journal, a newspaper publisher with its own large stock portfolio. He is best known as Berkshire Hathaway's vice chairman and Buffett's longtime business partner. Munger, a vice chairman of Berkshire Hathaway, also controls Daily Journal, a publicly listed newspaper publisher and investment firm that has nearly increased its stake in Alibaba for the second time in recent months. Daily Journal owns 602,060 shares of Alibaba as of the end of 2021, according to a report with the Securities and Exchange Commission on Tuesday, a position worth $71.5 million. That's nearly double its holdings from the previous quarter, when Daily Journal had 302,060 Alibaba shares worth $44.7 million. Munger, who turned 98 on New Year's Day, has increased his stake in Alibaba as the price continues to tumble due to the fears of a Chinese crackdown on big digital firms, as well as concerns about the company's slowing profits growth. Alibaba stock dropped 20% in the fourth quarter of last year after losing over half of its value in 2020. Munger's investment on Alibaba is notable because he has made a number of provocative comments in the last year supporting China's handling of criticism from internet moguls like Alibaba's Jack Ma. Although Daily Journal increased its stake in Alibaba in the fourth quarter, it did not alter its holdings in 4 other companies: financial behemoths Bank of America, US Bancorp and Wells Fargo, as well as South Korean steelmaker POSCO. Munger has also made news in recent months as a result of multiple stories about a unique design, most notably windowless dormitories found at colleges, where he has made major donations to subsidize student housing. According to Forbes, Munger has a net worth of $2.4 billion. The senior investor discussed his large economic view and comments on China, in particular at the Daily Journal Corporation's annual meeting in mid-March. When asked about his interest in Alibaba Group Holding Limited, Munger stated that he believed he could gain greater value in China in terms of the enterprise's strength and the price of the stocks than he could in the United States. He also mentioned that major venture capitalists in the United States were in the same boat as him when it came to China. Because of China's position on Taiwan, financial professionals in the United States are questioning the wisdom of investing in China following Russia's invasion of Ukraine and Western sanctions against Moscow. Munger was questioned about this, as well as the potential of Chinese companies being delisted in the United States for failing to comply with international accounting standards. The investor explained that he chose Chinese equities because he obtained greater strength per dollar invested and because the companies he invested in were cheaper but stronger than the competitors. In recent months, ties between the United States and China have deteriorated, particularly in terms of trade and related business activity. Due to the ongoing squabble, investors are wary of ownership in Chinese companies that trade on US exchanges as American depository receipt shares. Holding Chinese equities like Alibaba Group Holding Limited is similar to owning a sort of derivative, according to Munger, but he dismisses worries by invoking respect among civilized nations. During the annual meeting, the renowned value investor stated that, on balance, he prefers the risks he faces with Chinese stock ownership to the dangers he avoids. Munger's optimistic stance on Chinese companies is surprising considering his previous track record, which has largely consisted of US-based companies. Berkshire Hathaway Incorporated, Costco Wholesale Corporation and American Express Company, among others, have been among the top companies in the Munger portfolio over the years. Shares lost more than 3/4 of their value in less than 17 months. Alibaba lost more than $600 billion in market capitalization in the process, which is more than the combined market capitalization of all but 8 publicly traded companies in the United States. The simple explanation for the extraordinary drop is that regulatory changes in the United States and China have scared off US investors. Certainly, there is some truth to that story. However, this isn't the whole story. Concerns about Alibaba's stock are also focused on the Alibaba business, and given the elevated regulatory risks, it's possible that trying to time the bottom in Baba stock or even owning it at all, it's still a risky trade. Regulatory concerns are unquestionably a driving force behind Alibaba's long-term decline. It's no coincidence that the sell-off started just days before regulators launched a major crackdown on Alibaba. Ant Group, of which Alibaba owned and still owns 33%, announced plans for an initial public offering in late October 2020. The deal was expected to be the largest IPO in history when it was priced. The listing promised to put a price on one of Alibaba's most valuable investments, which would be worth at least $100 billion based on public market listings, while also bringing in capital for expansion. The IPO was then halted by the Chinese government the following week. Ant hasn't been made public yet. The stock of Baba dropped 8% as a result of the news, and the pressure from both the government and investors was just getting started. Regulators launched an antitrust investigation into Alibaba at the end of 2020. The investigation ended with a $2.75 billion fine and the hope that the worst was behind them. It wasn't the case. In April, more regulatory changes put Ant Group's business model in jeopardy. Regulatory pressure on the other behemoths such as Tencent and DD Global has remained constant. China's ruling Communist Party's new 5-year plan, released in August, proposed far stricter regulation of private industry, particularly tech behemoths like Alibaba. Alibaba is now under pressure all the time, on top of all the problems at home. If Chinese companies fail to comply with audit requirements, the US Securities and Exchange Commission is moving forward with plans to delist them. Alibaba is simply being squeezed in every direction. The dangers posed by these and other developments cannot be ignored. They are a serious threat to Alibaba's business and its investors. However, in the grand scheme of things, not much has changed. Since Alibaba's IPO in 2014, regulatory risks have been front and center, or should have been front and center. This is the country's largest corporation, despite the fact that it is still governed by a single-party communist government. Investors in the United States don't even own Alibaba stock. Rather, Baba stock represents a stake in a so-called variable interest entity, or a VIE, which is ostensibly entitled to ownership of Alibaba profits according to the company's Form 20F annual report filed with the US Securities and Exchange Commission. Because the Alibaba VIE is based in the Cayman Islands, any claim that US investors might have against Alibaba should the company act in ways that are not in the best interests of the US shareholders could be limited. Given that many experts believe VIEs are illegal under Chinese law, these kinds of risks have always been present. Chinese or US government officials could have inflicted this kind of pain on Alibaba shareholders at any time. To be sure, Alibaba isn't out of the woods yet. Even as competitors catch up, the company remains a force to be reckoned with. The Chinese central government is unlikely to want one of its flagship businesses barred from US markets, and the SEC and other US agencies do not want US investors to suffer further losses worth billions of dollars. There's probably room for a compromise. Alibaba's story doesn't have to end in a forced breakup, delisting, or some other disastrous outcome. But that doesn't mean Baba stock is a good buy, especially after a 50% rally from the lows. Regulatory risks aren't going away anytime soon, and neither are the fundamental concerns. Focusing on the fundamentals has a real problem when those fundamentals literally apply to a different company. In theory, the total value of future cash flows, discounted for time, should be equal to the stock price. Alibaba investors have little confidence that they will ever receive those cash flows. The current sell-off has been extraordinary, but it is largely due to real factors rather than a panicked market overreacting to unlikely outcomes. Baba is going to be a high-risk play as long as Alibaba stock represents ownership in a VIE, not a country, as long as the Chinese central government persists being communist, as long as US-China tensions remain high. It's difficult to take those risks when fundamental concerns outweigh the potential rewards. Tell us your thoughts on Charlie Munger and let us know your favorite stock picks for 2022 in the comment section. This ends today's video. Thank you for watching the video. If you enjoyed it, please like, share and subscribe to our channel for more awesome videos like this one. See you in the next video.